All right, everybody. You go here, the real uplift everyone to the greatest of all time. Here to show you how institutional order flow works, how to identify UFOs, unfilled orders in the markets, and how to take advantage of it and ride the coattail with the banks instead of chasing price action like everybody did this morning. But we gonna get into that in a little bit. Let me just go ahead and show y'all real fast on how I actually prepare myself to using my economic calendar, my nice little news terminal. Let's just show y'all where a lot of traders went wrong, who lost a lot of money, and some made money, but you still guessed on the market because you were still chasing price action at the end of the day, still risking more. Yeah, you made money, but at what cost, right? Probably heart was pounding. He was like, man, I'm over here. Oh crap, it's getting there, it's getting there. Yeah, I'm making money. And the other is like, oh man, I hope it come back up there. And yeah, every retail trader, at least most, chase price action. Now let me show y'all exactly how to actually prepare yourselves for a news release. This is exactly what everybody failed to identify. So NFP, this was the expectations of the NFP release, right? This is what the market's already pricing in and what they already expecting to happen if it releases on one side or the other, right? Stronger growth, we see US stocks drops, get weaker, dollar gain strength, US yields gain strength, and gold drop. What did we see this morning? We seen exactly that. And you know where all the retail traders did? Chase price, hoping for the best, gambling, poor risk to reward. Yeah, this is the first mistake of retail traders. They don't prepare. It is assume, predict, and chase. Reactionary, right? Financial institutions, they analyze data, prepare proper risk management, and they come up and fill in their orders because that's the only thing that they have an issue with. They don't have no issue moving the markets. We got to keep in mind, they are the market movers, okay? So I'm gonna get to that in a second. But this was the exact reaction that we seen this morning. Stronger growth in the labor market, right? If it came out weaker, we could have seen a possible reaction of US stocks rising, dollar getting weaker, yields getting weaker, and gold rising. Because that will give the Fed, that will signal the Fed to really cut rates, maybe in December, right? But since we got a stronger release, better than expected, right? We definitely seen a reaction this morning. So let's go ahead and get into the deeper aspect of institutional order flow. This is the basics, pretty much. This is the first thing that professionals identify in the markets, institutional traders identify in the markets. They do this first before they even decide to look at any secondary confirmations. So let's go ahead and look at gold, for example. Gold is more of a day trader asset because it has more volume than your average asset, right? It moves extremely fast, a lot of liquidity that comes into gold, right? So since this is more of a day trade, we're just going to drop down to the dailies and we're going to start from a minimum of three, three confluence time frames, all right? We always want to start from the highest time frame and continue all the way down. Because the highest time frame is the most powerful, right? It takes a lot of capital for an institution to move the markets. Something that us retail traders can't do. We could all come together, put our little money together, buy some shares, 50,000, 100,000 shares. Would I put a dent in the market? Would I even move a candlestick? No, right? We don't have that type of power unless secretly rich, then let me know if you got that millions and trillions of dollars, billions to be able to move the market. Let me know. You are the market mover. But if you don't have that type of capital, you're not affecting the markets. All you're doing is possibly chasing the markets instead of trading with the institutional banks, right? So let's dive a little deeper in this. I'm gonna start fresh. Go ahead and delete all this. Move my drawings real fast. So we're gonna start from the top down. We're on the dailies, daily time frame, right? We're gonna identify exactly where institutions bought or sold at, right? So let's go ahead and widen this out because when you widen it, you actually can have a more of a clearer view of the markets. Actually get a precision on the markets, right? So as we can see, we already was at all-time highs. Many possibly bought up there too, but we ain't gonna talk about that right now. So how do we know if an institution bought, right? Or sold? How do we know that an institutional bank bought or sold? Pretty much a large imbalance candle, right? If we have basic candles, which pretty much means that the markets don't move at all. Take this for example right here. We got this large imbalance candle right here, right? Then we have a slight pause. We got base, 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 and then rally. This is where we had a fight between buyers and sellers. And as we can see, sellers won, right? Same thing in this area right here. As you can see, we see a base candle, an impulse up, impulse down. Then we got a basing candle right here, and then we see a impulse up, balance, and an impulse up again. We see that institutions bought heavily in this area. So this is the area that you will also mark off too, right? So that is a literal foundation of market structure right there. Identifying IOF, institutional order flows, where institutions bought heavily at. Are they the only ones who can move the markets? They have the capital to do so, billions and trillions of dollars to be able to move the price of gold. Now, let's start to identify exactly where these areas are. So, I'm gonna take my little rectangular little box real fast and we're gonna start identifying, right? We're gonna come over here to the most recent because yeah, usually want to start in the recent areas so you can get that more of a precision. And I always want to check over here too if it even broke any other supply zones or demand zones, right? So for example, let's go ahead and start right in this little area right here. So as we can see, we got a base, impulse down, impulse up, and another base and candle right here. Then we see a little impulse up and then impulse up, right? Base, rally, rally, right? So we're gonna go ahead and mark off this area right here where institutional banks bought heavily at. Same for right up here. We see base, rally, base, and then pivot reversal down, right? We're gonna go ahead and mark off the supply zone up here, and we're gonna mark that as red. So we got the demand zone down here, we got the supply zone down here, up here. All right. We have one right here, as you can see, and you always want to start from the base of the candlestick, the top of the basin candlestick, not the wick. Remember, wicks do not break zones. Okay? So we're going to start right here on for buys and then mark down and label it green. Let me label the demand zone right there. And I'm gonna show you exactly what happened. As we see, came up and broke down. As soon as it closed right below this demand zone, it became invalid. Okay? We can go ahead and delete that now. So these two zones right here are the most valid zones on the dailies. Now let's go and continue down to the 4 hours and see exactly what happened. Let's go ahead, open this up real fast. All right. So this is where confluence come into play right here. We have multiple time frame correlation. That right there is the best trading opportunities to have when you have multiple time frame correlation within a supply or demand zone. We have, as we can see, a nice basing candle up here. We got that rally down. And then as we can see, we're gonna go ahead and zoom on in. Got another base, rally down, and rally down. Somebody so heavily right there. So we're gonna go ahead and mark off this basing candle right here also. And when it comes back into these zones, that's where we want to look for opportunity for sales. Usually when we in these areas, people be buying in these areas, and that's the wrong thing to already do. You're already feeling right there. You're already feeling it right there. Okay? For the buys, as you can see right here, got a base candle right here too. Base, rally down, base, rally up, reversal. We'll mark that right here as a demand zone. Okay? And as we see right here also, there's another basing candle right there where institutions so heavily at. That is the literal foundation of market structure. Yet nobody don't understand it. This is how institutional and professionals trade. So as we can see, we got our nice demand zone, got our nice supply zone up here. And in this area is where the trade of the day that I had 2 days ago that I meant to release, but went to the dentist and I was out of commission for a minute, but that's another story. We see right in this area where I also took advantage too. Trend line, a trend. 3 directional segments must be established too for a trend. Usually people get trend wrongs too. So when you're on a 4 hour, the daily, we're just looking for structure, right? 4 hour, we're looking for trend, and then the hours, we're looking for entry. 3 minimum for a nice confluence between time frames. So at first we was in an uptrend, right? We got a low. Well, first it was a downtrend. Let's just start there. First it was a downtrend. This was the control point right here for the downtrend. As soon as we came up and broke and closed right above this area right here, soon as we close right above, we establish a new trend. This trend is now invalid. And 3 directional segments, it has been established. We got a higher high, higher low, higher high. 1, 2, 3. 3 directional segment. We created a bullish trend. As soon as we came in this area, we are still technically in a uptrend until this candle closes below this control point right here, the last higher low. That is the next control point right there. As soon as it closes, it will establish a downtrend. Remember, wicks do not break zones. And this is where people also get confused at too. So, right now, we are currently in a non-directional movement, right? So let's continue. Let's go ahead and stretch this out a little bit. And we also see another basin candle right here. After this impulse, got a base, 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 rally up. So we're gonna also mark off the last basin candle right there. And then, man, as you can see, it's still valid. This area is still valid. This is where we want to look for the first touch at, okay? As soon as we get that impulse, UFOs are most likely down here because the institutional bought heavily here, but was they able to fill all their orders though? Most likely not. They probably bought 10 billion of gold or whatever the case may be, and was only able to fill 5 billion. And next thing you know, they want to go ahead and fill out that last little bit of 5 billion that they possibly have down there. We always want to look for first touch. First touches. As soon as it went up and came back down, this was the first touch right here. Right in the little area right here is the first touch. This is where we would have bought right here. Stop loss below the zone, the demand zone, and we take it up to the next institutional order flow zone, okay? Where banks so heavily at. This will be your first TP. That easy. And then you could have took it down as soon as it hit these orders up here. First touch. It touched for the first time up here. That is the foundation of market structure. It's really that easy. And this is the basics. So after the first touches, it becomes weaker as it continue to hit, right? It's only a certain amount of unfilled orders that it can continue to fill before it runs out, right? So as it continue to hit and hit and hit, it's weaker and weaker and weaker. This right here, after this point, I wouldn't even look for buy opportunities. And if I am going to look for buy opportunities, I will have to look for confirmations. I got to look for a close, at least above this demand zone. But that will be a higher risk at the end of the day too, because what we're looking for, a 1-to-3 ratio. That is the best minimum risk reward that all traders should be having in their arsenal is a 1-to-3 ratio risk to reward. We don't want to have a 1-to-2 or 1-to-1. If you do, it's going to be harder to make back those profits if you lose compared to a 1-to-3. You could lose 35% of trades. I mean, you could win 35% of trades and still be profitable if you have proper risk management. So, with that being said, first hits only, y'all. First hits only. That's exactly where we would have bought it. That's exactly where we would have sold it. After that point, it's done. We're going to look for a new structure. We're going to look for the next viable opportunity, which is down here. The next area of demand where banks bought heavily at. Right? Now let's go ahead and go down to the 1 hour where we look for entry. And as we can see, that would have been a perfect entry right here. Definitely have a little buffer, because spreads and things like that. But overall, perfect trade for this morning, right? Same thing with this sales right here. There was also a perfect trade too, right? Actually, this was the morning trade. My bad, y'all. This was actually the trade idea after the came out and stuff. Came down, did his thing, and then started playing around because of the uncertainty in the markets, right? We still don't know if we're getting rate cuts, but that goes into a deeper understanding of fundamentals. But I'm just here to just teach the basics of IOF and UFOs, unfilled orders, and institutional order flows. So after that, I did take a small scalp on a 30-minute time frame after markets reopened back up, right in this little area right here, where we were still in the demand zone. Institution bought heavily right here. Came down, hit those unfilled orders, and I took it up for a quick little scalp right to these unfilled order right here. And as you can see, it came back up, hit those unfilled orders, and then continued down. So this is literally a back and forth thing. Back and forth of orders being filled in, filled out. This is a continuous thing. This is the foundation of market structure. So with that being said, y'all know the basics now, at least for the most part. But remember, always start from a higher time frame. Every other asset class, Forex, or you're looking at the stocks or options and futures, if you're looking at UJ, for example, you always want to go ahead and delete all this real fast. You want to start from the monthly, at least, and identify institutional order flows, right? Let's see, we was in consolidation for a while up here. But this was the most recent institutional order flow right here. We've seen a base, drop, base, rally down. Then we see a base, rally up, right? Where institutions bought heavily on UJ, right? This is the area where we are mark off on the monthly. Just like that. Once it comes back down in this area, it's going to most likely fill in some orders, right? And then you drill down to the weeklies to see the actual trend, see if it's an uptrend, downtrend. Remember, 3-directional segments, right? So right now we're currently in an uptrend, right? If you want to look at it better too, I would suggest going to a line chart because you actually identify a little bit easier as far as higher highs and higher lows, right? We see we then got that low right here. And we see a higher high, higher low, higher high, right? We got a 3-directional segment right there. 1, 2, 3. The control point is right here, the last higher low. So as soon as it comes down and break that area, we will start to see a downtrend, right? But if it comes down and respect that area, and fill in whatever orders that could be possibly in that area, then we can see a continuations, right? That's simple. Got that nice little rally up, got that base candle right here, and rally up, right? As we see, went up, and then it came down, touched for the first time, and then continued up, filling in those orders right there. So yeah, that easy. Go to the dailies. This is where we find our entry, right? Most likely we're to enter in right there, right there. The nice little confluence right there. Multiple time frame correlation. Even more powerful. Came in, hit those unfilled orders, continued up. SL will be right below that. And then you have a nice little buy order right there. Come in, smack, went up. First hits. After the second and third hits, I will look for confirmations. That is the foundation of institutional order flow. So I'm gonna end it right there for now. Hopefully, y'all actually learned something from this and kind of seeing how the market works. Hopefully it's starting to click a little bit like, I see it now. I'm starting to see it. I'll probably do more examples of this in the future, or even some live calls so if we all go through this together. But this is the little foundation of market structure. Follow where institutional banks buy and where they have unfilled orders at, and buy with them or sell. That easy. So with that being said, I will let everybody have a great night. I mean, I hope everybody have a great night. I'm gonna let everybody go, and y'all go ahead, do your thing, study this video, watch it again, and start to identify institutional order flows. Okay? To go is out.